I have the conversations with people, things they didn't hesitate about 2 years ago that they're now hesitating on.
Your local soccer game conversation is tell me your debt equity mix of that smoothie you just bought.
That is what I'm saying.
Half cash, half stock.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
That's how you drive. From now on, that's how you drive. Name that classic film.
Taxi.
I mean, you named something that has a vehicle in it, which honestly I'm very impressed by. Bad Boys. Bad Boys.
I see where your classics are good.
Yeah.
Next week is going to be Bad Boys 2.
Spoiler alert. Okay, people, now you don't have to tune in next week because you done ruined everything. Welcome, everybody. SkippyDoogles@gmail.com. That's where you can go to send us listener mail. SkippyDoogles.com, where you get all of your Skippy and Doogles information. The primary conversation today is going to be about IPOs. We're going to walk through some academic data on that and see where we are today relative to history. And then we'll hit on a couple other small things. You know about my joy, okay, I can't even, do you know about my boy, Jay Ritter?
No, I don't. I know very little about Jay Ritter.
Jay Ritter is one of those people that is always collecting data in the background. It's kind of like Fama in French, right? Like they're always just collecting data, and if you want to get raw material on something, you can. Jay Ritter does that for IPOs. So he's been, for a long period of time, collecting data on I to the P to the O's. You sent me over this here week something from Meb Faber, a tweet that he sent out that was showing IPOs by decade from 1990 to today. So, of course, I wanted to go to the source. And so I went and took a look at some of Jay Ritter's data. So we're going to talk.
I'm just going to correct this for you. Jay Ritter is the director of the IPO initiative at the University of Florida. You described him as if he plays bass guitar for Third Eye Blind or something. Like he's just a guy. The IPO initiative.
Well, Third Eye Blind. Semi-charm kind of life. Baby, I want IPOs. Anyway.
If this is the first time you've ever listened to the show, you have no idea what's happening right now.
If this is the 300th time you listen to the show, you have no idea what's happening right now. Because we like to keep you on your toes. Anyway, back to IPOs. If you look from the 90s, and Jay Ritter's data goes back to 1980, by the way. But if you go back to the 90s, at a high level, generally speaking, I would say that IPOs are getting less frequent, the companies are older, and they're getting less profitable.
So I want to start with some overriding trends that used to hold true that maybe don't hold true anymore.
Oh, okay.
If you went public in 1990, one, there were very few companies, only 32. But two, 94% of those were profitable. It was a tough time to IPO, so only the cream of the crop IPO'd from a profitability perspective.
94%. Let's just stick on that for a moment.
That is
wild.
The business model is entirely different, probably much more capital intense, et cetera. But same holds true in 2008, 2009, where barely any companies IPO'd, 20 combined for those 2 years. But basically 70% of those companies are profitable. If you're IPOing at a tough time for the market, you were the cream of the crop. What has happened recently is nonsensical. I know you're going to do the whole background, but it doesn't seem to hold to those trends, which is very interesting.
One other piece of background info that's helpful. I recently finished this book, The Power Law, which I think I may have mentioned to you before. And it goes through the history of venture capital. And if you think about, I'm looking at the Jay Ritter data, which goes back to 1980. In the 1970s, venture capital was just getting going. It was like some of the earliest was with Apple, et cetera. So to your point, cream of the crop, VCs didn't have an incredible track record. Like they weren't 40, 50 years in like they are today. And so in order for someone to believe that some wishy-washy nonsense company they're bringing to market, you have a higher bar that you had to pass. And the markets were also less sophisticated. So one other trend I'll throw out is the data looks at price to sales ratios as well. And so just generally looking at that over time, the price to sales ratios have also been increasing, but there are really two periods where they feel fully off trend. Those two periods, and I'd say the median, I'm just eyeballing this is not calculated, but the median is like in the 80s was about 3. In the 90s was about, let's call it 4. In the knots, so the 2000, 2010 area, let's call it like 5. 2010 on, it's also about 5 or 6, something like that. But then there are these couple periods. If you go from 1998 to 2001, it spikes up to 40 and then comes back down to even 15. But there you're at least in the teens, basically at that point. The other period of note is after 2020. So from 2020 through today, you also have a spike up to like 20. And right now it's saying in 2025, you had almost a 12 price to sales ratio on average for IPOs. So we are in an inflated, call it bubble, call it whatever you want. We're in an inflated period. And it's an inflated period that over the last 45 years, you've only really seen some variation of between 1998 and 2001.
Yes, but if you're already jumping to like the let's make conclusions about today.
No. Just go.
Okay, good. It does seem like things are maybe slightly elevated right now, but what's happening is there's like no IPOs. So the data set, the way I describe this is the data set is incomplete because SpaceX and Anthropic and OpenAI and Stripe and a bunch of other companies that would have IPO'd in any other era already aren't here. And so this data, like especially the price to sales metrics you're talking about now, will look drastically different.
Be higher.
Potentially
Be higher.
6 months from now.
Yeah. I think it's interesting in this discussion because when you read some of the Twitter comments, they take this data and they say some version of defending today. So some version of, yeah, but if you look at the price to sales ratios, price to earnings ratios of the companies back then, they were much higher than today. True. To your point, for public companies. But this is why I'm just supporting exactly what you just said. If you look at all companies that are the size of what would have been public back then, that's like a different data set. That's your incomplete point. I think I'd be fascinated to take a look at that because when we were looking at the numbers for SpaceX, I can't recall them, but they were triple digit price to sales and price to earnings. I can't remember which it was, but they were like triple digit numbers. That's very different than what you're seeing on average here from IPOs. So 2026, this will be fascinating. The number will probably still be like 8. Like it might be a low number, but the price to sales number is going to be much higher. And they're not I'm not sure that any of those companies are profitable. I don't know about Stripe, but the rest are not profitable.
I thought SpaceX claimed to be.
If I took the list of things that Elon Musk claimed to be.
Listen, he just has to roll up, buy, sell 7 other companies that he owns, and he can do whatever he wants with the books. Mm-hmm. I mean, this is like...
I will tell you this. I don't know who the last African-American was to take a company public, and I'm glad that Elon Musk is going to take that cake in this year. So I can't even get a chuckle over that.
I mean, I'm just not touching it. I know when to keep my mouth shut. There we go.
You know what else so there are a couple things that couple other pieces of data that I really wanted from this that I won't get. One is maybe they're both, what do you call histograms? I think they both might be, but I'm really curious when you say 22% of companies are profitable versus 90%. What's the magnitude of profitability? Like, yes. And by size, by company, by age is the other one I'd like to see. Are the companies that, if you have the average median age in 2025 is a little over 10 years. Those companies that might be 3 years versus those companies that are 10 years, is there a difference in profitability? Right? Like that's really interesting because if I say companies are taking longer to go public and they're using all that time to not be profitable, that is very different than saying there's a bunch of young companies that aren't profitable and that's the 80%. But then there are companies that are older and they're profitable. So I'm just curious.
I mean, what you want, I understand why you want it. The sample size just kind of doesn't support making conclusions on it. But people, if you did if you were around in, say, 1995, 1996, from 1995 to 2000, looks like roughly an average of 200 plus companies per year IPO'd for a
That's so many
6-year
companies.
stretch. And in the past 4 years, there's a total of, goodness, like 60 companies that have IPO'd. I mean, we're talking 200 a year for 60 total. It's like an entirely different world.
Yeah. I think that gets to your point that you were saying earlier about being incomplete. If you, back in the late 90s, it was more, you could plausibly say that you could understand the health of like larger American companies by looking at the public market.
Yeah.
And today you can't.
Yes.
That by itself, there's a lot of hidden economics that are sitting today. And so, yeah, to your point, I mean, if you're looking at it like 6 companies going public in 2022, that's wild. If we're saying that this is a comparable time to back then, to the late 90s, and let's just say that next year things crash, making it up just for the sake of this. So if you say next year things crash in 2027. So if 2027 is the year 2000, and then we just go linearly, that means that in 2024, a couple years ago, was 1997. In 1997, you had 174 companies that go public according to this. And in 2024, you had 15. There's just so much that we don't see. A lot of, and like whether it's a hidden danger or hidden amazingness, who knows? But we can't look at data that we have access to. You cannot look at to figure out who might be in a lot of debt, who might have cash coming out the he's. It's just really hard to know.
Yes. Are we ready to put a bow on this, though? I mean, is as fascinating and as good as this data set is, in terms of what it actually means, I'm not sure.
No, we don't. We don't know. But the other comparison, I'll say, going back to 1997, half of the companies were profitable that went public.
I'll tell you, the thing that's just almost unbelievable is in the 90s, like 60% of the companies that IPO'd were profitable. That feels like a different world.
Yeah.
My expectation for IPOs is I usually would never touch them because they're not profitable and they typically have a long way to go in the recent past. It's crazy. I wish that was the case.
I know. And the reason, we probably should have said this at the top, one of the reasons that this is being put out right now is because the narrative that's told now 25 years after the dot-com bust is that all the companies back then that were going public were all these unprofitable bunches of nonsense. It was all pets.com and like that. That's the narrative that's put out. But when you look at the data, you go, actually, a lot of the companies were very profitable. Valuations were inflated.
With one caveat, things really went crazy in 1999 and 2000. In both those years, only 14% of companies were profitable. The median term of launch was the lowest on record here, 4 or 5 years.
Yep.
And basically 300 companies each year IPO'd. What happened in those 2 years is the frenzy of what they watched happen in the mid-90s, where IPOs went public, were generally profitable, and did well. Yeah. And people then said, oh, well, pets.com works all the way around, right? We're not seeing that trend.
Yeah, and I'm going to leverage that in a moment here after I say one more piece of info that's just piggybacking off that. So as you said, lots of IPOs, 1999, 2000, 14% were profitable, 4 to 5 years on average that they were around. Okay, now look at today. Again, sample size so small. But today, it's roughly 20% that are profitable. So I would just say that's comparable to the 14. Average age is like 3x as old as they were. And going back to now I'm going to just piggyback right off of what you said, going back to the hidden market, incomplete data set. I'm going to use that to talk about the new Robinhood retail venture fund that's coming out. So we've talked about, this is the second Robinhood fund we've talked about. And we've discussed the Angel List fund that they put out there with the idea that more people are going to get access to private companies. Ignore whether that's a good or bad thing. For the time being, what I'll say is that if you take the fact that a lot of the market today is hidden, it's not visible. We actually don't know how the companies are doing. And people are putting more money into that and the private capital conversations that we've had. We just don't know how things are.
Are you hypothesizing that we're seeing more investment vehicles get made for people to put money into the new IPOs, which are hidden from the public markets? And in a lot of cases, for earlier stage companies,
Yep.
earlier stage companies are much harder to be profitable.
Yep. And the new Robinhood fund is going earlier stage. Yep. Keep going.
So you feel like there is maybe some parallels here, tougher to quantify, with the amount of money going into what would have IPO'd in 1999 or 2000 that does not IPO today?
Yeah. And my guess would be it's not bueno. My more than hunch. I don't know what is above a hunch, but something you still don't know. My inclination, like what my whole soul is pulling me toward, is saying that based on the information that we do know, based on the price to sales and price to earnings multiples that we do see in the market today, based on what we see happening in private credit today, based on what we do know about OpenAI and SpaceX that are looking to go public and the information that we do have, my guess is that the market out there that is not private, that is not public, these private companies that are sitting out there are not awash in cash that is spewing out. They are not highly profitable. Like, that's not going to turn this roughly 20% profitability number into a 50% profitability number. It's probably going to take that down. That would be my guess.
Agreed. I think that's a fairly well-established fact.
You went beyond soul pulling.
Sorry, fact is a little strong. But yes, that's my inclination too. Let's use your language. It does not reconcile. So, I'm just going to be a broken record. Complex adaptive system. What will break this time is not what broke in the early 2000s.
Yep.
I don't know exactly what it is. We've speculated it could be private credit. We've speculated it could be other things. It's nearly impossible to follow all the complexities that are happening here, though. So the S&P 500 dividend yield is trading around 1.1, which is the lowest.
Yeah, it's low.
Basically, it's headed towards all-time lows. The NASDAQ free cash flow yield is also headed to historic lows, around 2.5. The market felt bubbly early in the year, like January, February. Mm-hmm. Then we got a somewhat significant pullback related to tariff stuff. Actually, no. Let me rewind.
Iran.
There's so many conflicts that I can't even keep them straight. If you rewind back to 2024, early 2024, things felt bubbly. We got a pullback related to tariff news. Then we kind of rebounded from that, got back to higher valuations. Then this year, we've dealt with the Iran war and all sorts of other emerging market interesting news. But we're back to all-time highs, and it doesn't really feel, to me, the market right now does not feel different than early 2024.
Yields, 30-year bond yield spiking, oil spiking, and stock spiking all at the same time, and inflation spiking. The story doesn't make any sense. I wasn't going to talk about this, but I will briefly, just because I just think it makes me chuckle. So I saw this piece that said that Trump, as part of the ethics, Office of Ethics or something like that you have to disclose information if you're president as to what you're trading. Trump disclosed over 3,700 trades in Q1. You triggered that for me when you said conflict, because the first thing I thought about was conflict of interest. But actually, as I looked at it and read this piece, it wasn't even about conflict of interest. It's like, how? I wouldn't even know. 3,700 trades in 90 days? I don't even know how to do it. It's almost impressive. That's all we have to talk about.
No. We're going to attempt to reconcile. We're going to continue to talk about the complexities, right? We talked a little about early 2000s and how, from the IPO perspective, that doesn't make any sense. Mm-hmm. But in the early 2000s and in the 2008 great financial crisis, it was clear there was instability in the markets and the valuations didn't match that, right? Even if you can pretend that that's where we sit today, one thing that's entirely different is the amount of government spending that's happening.
Mm-hmm. Yeah, that's true.
And the deficit is huge. We are spending as if we're coming out of a crisis, even though the stock market is at all-time highs. Yeah. So Where I'm going with that is, even if you can find parallels from previous bubbles, this bubble there might be like more logs on the campfire, right? There might be significantly more fuel. It's very possible that we could run another 30, 50%, even double from here, and go to valuations we've never seen. I just really we've never forecasted on the show. We always think forecasts are garbage because they are. But it is a time where it feels like this conversation is somewhat relevant again, which is kind of sad. I hate this conversation, right? But if you're following investing as of today, as of mid-May 2026, this is the conversation to have in my eyes.
Yeah. And I'll caveat, or I'll throw a wrench maybe into, I'm always going one step beyond. I'm going one step beyond caveat. I'm wrench throwing into an element of what you said. If you go back to the last two bursts, so the housing for the great financial crisis and the dot-com for 2000, what you can't know ahead of time is if something is going to happen and when it's going to happen. But if somebody went to, in either of those times, to someone that was knowledgeable about the markets and said, just so you know, in 3 years, there will have been a crash. If you know that for sure, they could have told you where it came from. Like, the where it comes from is not as difficult, I think, if you know that it's going to happen. So like today, I think we know what is wrong. What we don't know is exactly how, when, and I'd say whether in the near future. But it's pretty obvious as to where it comes from. Like, there's overextended spending promises, mostly because of AI, and someone's not going to pay a bill. Like, that is what's going to happen.
There's also some incredibly interesting trends around how many stocks in the S&P 500 are trading down while the market still makes all-time highs. This is a few weeks ago, but like basically 300 of the 500-ish stocks traded down, but the market still went to an all-time high. It speaks to the concentration of only a few names that really matter to market performance. It doesn't give you the impression that the market as a whole is incredibly healthy. It seems like something else is going on.
Yeah.
So
the top 10 stocks by market cap in the S&P 500 today are about 40% of the S&P 500 index. 40%.
Yeah.
So putting some math behind what you were just saying, if those stocks did nothing, they just stayed where they are, and the rest of the index went to zero, what would happen is a bit more than what happened in the Great Financial Crisis. Now, that's a really wild situation. But if everything else goes to zero and those stocks double, you wouldn't even notice that anything was happening. Like, that's what's so wild when you have concentrated math like this, is that so many of the stocks could be terrible. You could have NVIDIA goes up by 3x and you're like, oh, actually, like, the stock market's up 5% this year. That's the way this math works. And so the aggregation hides so much when concentration happens like this.
I mean, basically, all that matters is Broadcom, as you know, Doogles.
Oh, like,
basically,
let's call a spade a spade. Let's call a spade a spade.
All right, you mentioned Meb Faber earlier. I'm sitting on a similar topic, but actually want to relay some more information from his podcast. U.S. consumer sentiment fell to the lowest reading on record. This is at least since 1970, but I think even going back further than that. And folks have used this to hypothesize the K-shaped economy. If you're not familiar with that term, and why would you be? This effectively means investing going up. That's the top part of the K, and consumer sentiment and spending, basically the real purchasing power and the real financial health of your average American going down. Right? This is what people are describing with the K-shaped economy. So Meb had Tom Lee from Fundstrat on the podcast. I'm not a huge fan of his, but found one thing he said to be incredibly interesting. I'm not even going to go into the politics, but he talked specifically about the University of Michigan survey, which is the longest running survey on consumer sentiment, and how over the past 20 to 30 years, they have changed the way that the polling is done. It's now entirely online. It used to be over the phone. Because it's entirely online, it ends up targeting a different demographic of consumer, et cetera, et cetera.
Yep.
His hypothesis is that this reading, because the makeup of the respondents have evolved, that this reading actually doesn't tell us what it used to tell us.
What does he think it tells us now? What did it used to tell us?
I was trying to steer clear. You know I hate politics. I mean, the makeup, we believe, although I don't think we have good data on this, I say he believes, used to be fairly 50-50, and it used to be not influenced by politics. Now it's like 2/3 one party and a third the other. Whoever party is not in power tends to, on economic surveys like this, say that everything's horrible. And so if the majority of respondents are folks that aren't represented in the White House currently, they're more likely to say things are bad. I just find this to be an incredibly interesting conversation around some of the data that gets thrown around as gospel. I was in that camp. I mean, this is the most trustworthy, longest running survey on how the American consumer feels about the economy.
This sounds so naive, and maybe it just is. I do not understand how anyone can look at what's happening out there and be like, things are good. I also didn't understand how that happened 18 months ago. So like, to me, that's not a political thing. Like, it's felt obvious to me that there is a large segment of the population that's not doing well. I don't know how now that would be improved when inflation is higher than it was a year ago. Oil prices are higher than they were a year ago. When debt is higher than it was, deficit is higher than it was. We are now in a war. It doesn't feel surprising that consumers would feel worse than they did a year ago. What feels kind of wild to me, maybe this gets to the difference though, is if you go back to the 70s, I'm just going to call that more awfuler. Like, it was so much more awfuler back then, objectively. But sentiment. Everything's relative to what the expectations you have for your life and what you see that other people are doing that you're not, right? And so it's different.
I mean, remember the French polymarket guy that...
oh, yeah, the hairdryer?
The what?
The hairdryer guy? Or the guy, the Donald Trump survey guy?
The Donald Trump survey guy. And
we might be the same guy. Do we not know it's the same guy?
They're both smart. Before the election, he paid with his own money to have surveys in America conducted in swing states that asked some version of a question of not who will you vote for, who will your neighbor vote for. So, Doogles, yep. I'm just going to push back a little because I want to try and give a fair representation of all sides. What you just talked about with how horrible things seem, I'm generally on board. But at the same point, if you ask me, like, how my neighbor's doing, if my neighbor's going to buy a new car, if I think my neighbor's struggling to make ends meet, most of those answers will be like, oh, they seem to be doing great. They're ordering DoorDash all the time. I see them out and around town at fancy dinners, et cetera, et cetera. This is slightly hyperbolic, but you know what I mean. Like, it is one of those things where I look at the bad news and it feels like there's bad news everywhere else, but in my community, there's not really any bad news. People will have the same vacation plans, in some cases more extravagant vacation plans than they did before. It can't be all doom and gloom out there.
Okay, see, this is where, and we are not your typical people. We get on a microphone and talk about the economy for fun. So, like, we're not your typical people. But I see all that, and it scares the crap out of me. It's like when we were talking about Vegas. I go to Vegas and see all these people betting, and I know they ain't got no money. That scares the crap out of me. I go and I see people booking flights. I see people at these restaurants, and I'm like, that's debt. To me, all of that is debt. So like, that scares me. I don't see that as a positive sign. I see that as continuing to crank up the Jack in the Box that's about to explode. That's not how I don't think I'm a pessimist, actually. I'm just looking at consumer debt go up while I see spending go up. Like, that's all this is. So I'm like, this seems bad. But then I also see, we were watching the show Friends and Neighbors, so I'm just going to use that phrase. I also see friends and neighbors, and they still buy the thing, but I literally see how they're buying it. Like, I have the conversations with people around what they're not spending on, what they're thinking about, things they didn't hesitate about 2 years ago that they're now hesitating on.
Wait, you're your local like soccer game conversation is tell me your debt equity mix of that smoothie you just bought. Like what are you exactly saying here?
No, that is what I'm saying. That is what I'm saying.
Half cash, half stock? Is this like
Yeah, I mean, we're joking about it because it is ridiculous, but these are the kinds of conversations that I have. And I'm a guy who I think you're this maybe in a different way too. That people come and ask me things and tell me things that are different than what they go and ask and tell other people because they know that I'm into this stuff, right?
Yes.
And so I just hear things that might not be as direct as like, this is what my credit card balance is. But the questions they ask are not that far necessarily from that.
You know, I'm a bad sample here because I'm someone who buys cars with cash, right? So the whole debt conversation gets away from pretty
what
quickly.
I mean. We're different. We're different humans than everyone else.
In the professional world, I get quoted a lot when people's businesses are struggling, but that's a conversation for another day, right? You know, like that. It's effectively the business version of put too much on credit cards and I need you to get a way out of this for me. What I'm trying to say at a higher level is I think it's important to understand that there's 2 or 3 or 7 narratives out there, and none of them is perfectly right. When we talked about Bubbly valuations, probably back in early 2024, it was like the story is you can look at price to sales, you can look at dividend yields, you can look at 10 different metrics, and they all kind of say something similar about the market, right? The amazing thing is in the past 18 months, earnings have held up relatively well. And in the SaaS apocalypse that everyone jokes about, I mean, those companies still generally make money, generally buy back shares. Their valuations have been completely reset because it's not about what's happening today. It's about the terminal value that is assigned to those companies.
Yep.
But it can't be as bad as you're portraying it, I don't think, without...
Go ahead, continue, sorry.
When people's actions, like when in our communities, I'm not seeing any change in spending habits.
Oh, you need to open your ojos, bro. Open your ojos. Because my belief is that we're in what I call a dog's life economy. Are you familiar with that term?
I'm about to be.
Yeah, you're about to be because I just made it up. So you're about to be. Do you know how dogs live?
Happy. Yeah.
Yeah, exactly. This is how dogs live. Dogs run, die. That is a dog's life. Generally speaking, like dogs will push themselves because they just it's the joie de vivre, baby. That's how dogs live. I think that is a part of what's happening. And today, with all the medias of socialities, you can see the way other people are living. The keeping up with the Joneses is in your face at all times. And it's no longer like the Joneses that are buying necessarily all the fancy stuff. It's like the person that's still going out. You remember when we were talking about I think it was maybe a Reddit piece or something, but there was something where a woman was saying that she doesn't necessarily have the kind of money to go on vacation, but her friends are going on vacation and they invite her. And like, how do you say no to that kind of thing? I think there's a lot of that's happening. People invite you to things. But then so I was talking about the side conversations, but 2 other things, one of which you sent me. One thing that I'm seeing more of, this is non-scientific, anecdotal, but I'm seeing more and more as I go on my urban hikes. I just walk all around the city. Mm-hmm. I see more and more explicit signs around happy hours than I've seen in a long time. When I first moved to Colorado, here in Denver, happy hours were like the thing. Like I've never seen so many hours of joie than when I came here. They were everywhere. Then they didn't go away, but they were not as aggressive as they were when I first moved here. I'm seeing them come back. That to me is a sign that restaurants are looking for people to come in.
The fix to the economy is happy hours and like $1 drinks. That would fix every aspect of the economy.
No, but what it says to me is that restaurants are losing 10 to 15% of sales or something along that lines, and they need to get people back in the door. That's what it says to me. The other thing that you sent to me is the Costco thing. Because this is how things shift.
The Costco thing is sadly been somewhat debunked. Who are these people? This is the mini rant here. There was some Costco data going around the internet this week that whoever the user was and this is thank you, Elon, for making it hard to know who's trustworthy on X, pulled a report from 2023 and claimed that it had happened in 2026. Like, just exhausting to have to do that level of sanity checking on everything. Yeah, but there is, I mean, that's still relatively recent. There is some buying trends in supermarkets that tend to say the consumer is more strapped. There's tons of data that says the consumer is more strapped. I'm with you there. I'm not going to fight you I'm not going to fight you on that. Although the Doogles index of when I walk around town, I see more signs for happy hours might not be the most reliable data source here.
It's not the least. It's not the least reliable.
All right. This last week, this actually ties in nicely. This last week, through a interesting sequence of events, I ended up at a car country club. Have you ever heard of a car country club?
No. Is this like a dog's life? Is this something you just made up?
This car country club is a garage that houses, I'm going to guess, 50 luxury vehicles, ranging in price from like $2 million to, I don't know, call it 300,000.
I'm going to pause you for a moment. You have the weirdest life. Continue.
I do, yeah. And the way this car country club works is you pay a $65,000 initiation fee.
65?
Yep, 65,000, and then roughly 3,000 a month, and you can drive the cars. That's like the whole thing.
So it's like a pay to play car rental, or is it not really a rental? You just get to drive them once.
Now there's like the version of a clubhouse. You know, there's like a locker room and a conference room to host your business meetings. There's a F1 racing simulator. It's a country club for cars. I did not realize these things were in my backyard. I certainly knew they were, like, I think they're fairly big in LA, New York, maybe some of those places. This place is full of members, Doogles. Like, I'm not a car guy, so I miss, this just goes over my head. Yep. But speaking of K-shaped economy, like, I didn't know that was a thing.
That's ridiculous.
It is. That's your whole reaction?
Yeah. I mean, I don't know. Because I don't even know if that's K-shaped. I think it's like I-shaped, lowercase I-shaped, where you have
the dot on top.
Yeah, this is the dot on top, and then everything else is straight down.
Well, we've talked a lot about as much as 50% of consumer spending happening with the top 10% of individuals. This was definitely that case. I talked to the owner a little bit, and his philosophy around why this made sense. He's generally a car like broker dealer, effectively, where he's flipping really high end cars.
Yep.
And his point is one of those. I might look back at this as the moment in The Big Short where you realize it's truly a bubble. But his point was that if you buy one really rare, really high end, really unique car, sometimes you can flip it and make $50,000 or $100,000 on that one sale. Yep. Where if you're just out there grinding with your used Toyota Corollas or whatever, you make, I don't know, the rumor is $500 a sale, right?
It's a hit-driven business.
Why would you even entertain selling cars to your more typical Americans when you can 100 or 200x that with catering to like the wealthiest individuals in that market?
You know the answer to that.
I don't. Tell it to me.
Long-term sustainability. I mean, that is the answer.
If you only live for today, you're good.
That's right. I mean, it's the same thing as saying, why wouldn't you buy Oklo stock, which is going to go up 5x, instead of buying all these stocks that pay all this, what is this called, cash dividends? Like, what am I doing with that?
You're trying to bring sanity to the equation? I mean, don't tell people that when this game continues and he ends up losing $500,000 on one bad bet he makes with one car, that it doesn't pencil. Don't tell people that. That's not fun.
It's not fun at all. No, but that's all I'm saying. It's a dog's life economy.
Well, this show, I'm not sure if it went off the rails, but man, it's more speculative than usual. Could you keep us up to date on the Doogles happy hour index, please, going forward?
I have to systematize it, though. So now that's going to be 50 hours of my week.
SkippyDoogles@gmail.com. We're hiring several analysts to start tracking happy hour.
Well, I guess that's a wrap, right?
Yes, all thanks for the show or skippydoogles.com. If you want to check out the Substack, you can actually see the IPO charts and papers that we're talking about here, and the basis of Third Eye Blind as well. Next week on the show, I'm pretty sure that it's all your classic movie is all about Field of Dreams. But I will be waiting patiently until that Field of Dreams shows up.
Oh, you have no idea what's coming your way. No idea.
All right,
Thank you,
see
everybody.
you next week.